The global financial system is currently experiencing a violent and systematic reassessment of value. In just 80 minutes of trading earlier today, over $1 trillion in market capitalization was erased from the precious metals sector. Gold saw a sharp 2% decline, but silver was hit with surgical precision, plunging over 10% in a single window of high-frequency trading. While the mainstream financial news is calling this a routine market correction or a reaction to shifting interest rates, the cold, hard data suggests something far more calculated. We are witnessing a massive liquidity squeeze, where even the most structurally sound assets are being liquidated to cover margin calls in a crashing equity market. Welcome to Market Crux. Today, we are moving past the headlines to analyze the technical levels that failed to hold, the geopolitical triggers currently exploding across the Middle East, and why the physical reality of silver has become a world apart from the paper price being traded in the West. Yesterday, a very specific technical warning was issued across the professional trading desks of New York and London. The instruction was clear. If silver failed to hold the 150 exponential moving average on the hourly chart, a level sitting near the $90 mark, the path toward $84 and much lower would be wide open. As of this recording, Western spot silver is struggling to maintain $79. The level simply did not hold. For those who believe this is merely hindsight, these market movements were documented, time-stamped, and predicted based on the exhaustion of the current trend. This move was not a random blip. It was a mathematical certainty once the key support levels were breached by the selling algorithms. But to understand why these levels were abandoned, we must look at the multiple confluent factors at play, beginning with the terrifying geopolitical reality unfolding in the Middle East. In the last 48 hours, the geopolitical landscape has fractured in a way we haven't seen in decades. The Port of Fujairah, which serves as the United Arab Emirates' only significant oil shipping route that bypasses the strategic Strait of Hormuz, was hit by a massive explosion. Simultaneously, reports have confirmed that Iraq has been forced to shut down the Rumaila oil field. This isn't just any field. It is the second largest oil field in the world, producing 1.5 million barrels per day, or roughly 30% of Iraq's total output. When tankers cannot move, storage fills up. When storage fills up, production stops. This is precisely why we are seeing oil prices surge while the broader stock market enters a state of freefall. The algorithms that drive modern trading see a sudden supply shock and immediately price in a global growth scare. Since silver carries over 50% industrial demand, powering everything from the next generation of solar panels and electric vehicles to the massive processors required for artificial intelligence, it is always hit the hardest during periods of growth uncertainty. Gold, which has almost no industrial factory requirement, acts as a store of value and holds its ground much better. This is a textbook liquidity event, but the sheer velocity of the drop, 11% in 80 minutes, suggests that this goes well beyond a simple macro reaction. It points to a deliberate move by institutional players to flush out the market. Now, we must examine the staggering disconnect between Western and Eastern markets. While Western spot silver is being hammered down to $79, the Shanghai spot price is holding firm at $91. That is a $12 premium that remains intact despite the massive crash being engineered in the West. This divergence is the actual market crux of the current crisis. The paper markets are being used as a tool to drive the perceived price down, but the physical markets are refusing to participate in the panic. If we look at the ratios, the situation becomes even more absurd. The paper gold to silver ratio is currently 62-1. However, when we look at the actual physical world, the mining ratio, how much silver actually comes out of the ground relative to gold, is 7-1. The COMEX vault ratio is 11-1. The math simply does not support a 62-1 paper price. One of these numbers is going to snap, and history teaches us that it is always the paper contract that fails, never the physical metal. Adding a layer of mystery to this crisis, the Shanghai Gold Exchange has recently gone dark on its silver inventory data. For years, this exchange has published detailed weekly reports on their stockpiles. Yet during this historic price surge and the height of geopolitical chaos, the lines for silver inventory were suddenly zeroed out or left blank. When a major global exchange stops reporting its inventory data in the middle of a crisis, it is a deliberate decision, not a clerical error. It suggests that physical inventory levels have reached a point of depletion so extreme that they would rather not disclose the number to the public for fear of starting a global scramble. Meanwhile, in the West, we are seeing the opposite of a price crash in the plumbing of the market. Lease rates for silver are creeping higher, and the swap is turning increasingly negative. These are the early warning signals of extreme physical supply stress. It means the cost of borrowing physical silver is rising because there simply isn't enough metal to go around for delivery. While the paper price is being pushed down to scare the average investor, the biggest players in the world are quietly positioning themselves behind the scenes. Data reveals that over 2.8 million ounces were withdrawn from COMEX silver vaults on Friday alone. This metal was pulled from Brinks, CNT, Delaware, and JP Morgan simultaneously. Even more significant is the recent disclosure that a major, publicly traded corporation is now actively adding physical silver to its treasury management as a reserve asset. This is a massive shift in corporate strategy. While retail investors are being scared out of their positions by a sudden price dump, institutional buyers and multinational corporations are aggressively draining the physical vaults. They are ignoring the noise of the paper market and focusing on the scarcity of the physical asset. We also have to discuss the role of financial engineering in this crash. Recent filings show that Jane Street has become the largest holder of the BlackRock Silver Trust, purchasing over 20 million shares in a single quarter. This is a firm with a documented history of using massive options leverage to generate profit from volatility. When you have a firm that faces manipulation allegations across multiple asset classes, from equities to crypto, holding the largest chunk of a silver ETF, you have to ask yourself, is this price drop a reflection of value, or is it a reflection of positioning? When the firm that stores the metal and the firms that trade the derivatives both carry histories of market abuse, an 11% crash right before the New York Open starts to look like a targeted attack on long positions. We are at a point where you, as an investor, must decide which data to trust. Do you trust the fluctuating paper price driven by high-frequency algorithms and institutional games? Or do you trust the cold, hard reality of draining vaults, rising physical premiums, and a global industrial deficit that has lasted for 6 consecutive years? The geopolitical fracture lines are now fully drawn, with the United States and Israel on one side and Iran with Chinese diplomatic backing on the other. The stability of the old financial regime is effectively over. We have entered a period of energy terror and currency resets where cash is becoming king in the short term, but hard assets will be the only thing standing when the dust settles. This is a time for logic, not for panic. The markets are being moved by forces that rely on your emotional reaction to sell your assets at a discount. At Market Crux, our mission is to provide you with the data that the mainstream media chooses to ignore. We don't follow the hype, we follow the movement of the actual wealth. If you found this deep dive analysis helpful and you want to stay ahead of these global shifts with authentic, research-driven information, then you are in the right place. Subscribe to Market Crux and join a growing community of investors who value truth over trends. We want to hear from you. Are you watching the spot price as your guide? Or are you looking at the inventory levels and the physical premiums? We read every single comment because your perspective is vital to this conversation. Secure your wealth, stay informed by the facts, and I will see you in the next update.